for more, on what that could mean for you and how today's rate may influence Finance Minister Chrystia Freeland as she writes this year's federal budget. Let's bring in two chief economists. Stéphane Marion is with the National Bank of Canada, and Jean-François Perrault is with Scotiabank. Hello to you both. Thank you very much for making the time. Mr. Marion, I'll start with you. Was this generally in line with what you had expected would happen with this announcement?
I guess, unlike the groundhog, despite the good weather, Mr. Temeclem came out today and he saw his shadow. So no early spring cuts from the Bank of Canada. We'll have to wait this summer. So that's in line with our forecast, unfortunately, Vassy. I still think that, come the April forecast, they may have to reassess their guidance and maybe open up the door for these rate cuts that we're still expecting for the back end of the year.
Can I just follow up with you quickly on that? And do you mean by opening the door kind of signaling more specifically that will be coming sooner rather than later? Because today, and please do correct me if I'm wrong, Mr. Macklem did not want to seem to give that indication at all.
Yes, but at the same time, we saw business failures increase quite dramatically yesterday when the data was published by OSFI, right? The biggest increase, the highest levels in 19 years. So clearly, Vassy, what that means is previous rate hikes are impacting businesses to a certain extent that should impact also the labor market. So until he sees some impact on labor markets, he remains very patient, but we could be surprised as soon as this Friday. Next jobs report.
Right, understood. Mr. Perrault, what are your thoughts on the propensity or the likelihood of rate cuts beginning still in the middle of the year? Like, do you think that calculation or that prediction changes at all with the decision today?
I don't think there's anything new in what the governor indicated today. Our view is that rates are more likely to be cut later in the year, say around September, than earlier in the summer. And you can read what he said today as consistent with that, or you can read it as consistent with something moving a little bit earlier. The reality is that they are very, very data dependent. They have a forecast of how the economy is going to unfold. Obviously, the economy is weakening. There's no question about that. The challenge is it's not weakening enough in some sense. So even though people are feeling the pain, the question is, are we feeling enough pain for the governor to then say, I've done enough to make sure that inflation is on the way down? And it doesn't seem to be the case because we are kind of revising our forecast up reasonably regularly on the basis of data that are coming in, despite the insolvency data that came in yesterday. The challenge I think the governor has is, people want him to give an indication as to when rates are going to come down. It's normal because we look forward to that. But he has this very complicated issue of managing expectations, particularly in relation to the housing market, which has kind of come back reasonably strong in the last couple of months. Maybe February is a bit of an exception on that. And homeowners and prospective homeowners are keenly waiting for the Bank of Canada to signal when rates are going to come down. So there's this risk that if he starts talking a little bit more positively about the inflation outlook, or gives some indication as to when he might move rates, which I don't think he'll ever do, and hurts him in the sense that it leads to stronger activity in the housing market. Am I cutting out?
You were, but you're back. It's okay. We got you.
So just quickly, that expectation that rates are going to be cut, validated by him, might lead to a pickup in the housing market a little bit too early in the year for them to be comfortable then with actually cutting rates later in the year.
How cognizant would you be, Mr. Marion, of that? Because as Mr. Perrault was describing, I was thinking back to last year when the bank's governor sort of indicated he was prepared to pause. And even that, the degree, just that one sort of signal that he sent, the degree to which it impacted the housing market at the time was quite substantial. How cautious do you think he will be in that regard?
It's so difficult to answer this question, Vassy, because the idea of what's driving housing prices right now is unprecedented population growth, right? So we began the year at a run rate with yet another year of 1 million growth in population in this country. And the longer you keep your rates at current level, the less supply you're going to get. But at the same time, demand is surging because we have this significant increase in population. So it's you're between a rock and a hard place if you're the Bank of Canada, because you've never experienced this type of demographic growth. So my personal view is that I don't care about, if you exclude housing, we're well below 2% right now, and there's nothing you can do about the housing sector unless, population inflows slow dramatically. So I think your responsibility as a bank is to ensure that supply gets back online, and you're not going to do that by keeping rates at current levels. So I would encourage the bank at its net forecast to look through the shelter component of the CPI. As I said before, without shelter, you're already below 2%. And in any other instances, right, and I'm sure JF will agree with that, you should be in a position to be cutting rates now, but you can't because of shelter costs, driven by, again, something that you don't control. So I think that's where we differ a bit from the Bank of Canada's forecast.
And Mr. Perreault, what are the risks of overshooting, basically, of waiting too long to, I mean, you talked about the pain that people are already feeling, but that at a macro level, the bank needs to see more pain. Like, how much is too much, and what does that pain look like before the bank can say it's okay to start cutting?
No, I mean, that's, it's $1 million question in some sense. I think, to get a sense of that, you got to go back over history and look at, what we thought was going to happen last year as rates went up, as what we thought was going to happen in 2022 as rates went up. And the reality has been that all throughout that period of time, even though pain was felt, that pain was less intense than what I think everybody expected. So to count on that, pain materializing perhaps in a bit more sudden way going forward, is essentially a mistake relative to what's happened over the last couple of years. So I would argue that, as he thinks about the risks around the outlook, focused on inflation risks, he still has reason to worry. I mean, we know that wages have been increasing rapidly. We know that productivity has been declining up until today. We know that there are still labor shortages in some parts of the market. And we know that there are these things going on in international shipping markets that are at the margin putting upward pressure on inflation, along with a very strong U.S. economy by a reasonable argument to make that, there is actually some upside risk to inflation, which would require him to be a little bit more cautious as he thinks about the evolution of monetary policy in the next several months, just to reflect effectively what we're seeing, what we think we're seeing from an inflation dynamic perspective, combined with still some vigor in the rate sensitive parts of the economy. When you look at auto sales, when you look at housing sales, when you look at retail sales, which surprised in the fourth quarter, literally weak in January. The labor market, which remained reasonably strong, although it's a lot of government in January. So there isn't yet, I think, kind of an accumulation of evidence that suggests that we're getting close to the point where he might have overdone it, and it's time for rapid unwind of that.
Mr. Marion, I just have time for one last question. And I wanted to ask, because this is a political show and we're looking ahead to the budget, we just found out the date, the middle of April, what the implications of these rate decisions you think on the federal budget will be, and maybe more specifically, the degree to which you think the size of the deficit could ultimately impact, or size of government spending, level of government spending could ultimately impact inflation.
Actually, that's my biggest risk to the inflation outlook. What is government going to do? We already saw BC coming out with a stimulative budget. Now we're waiting for Quebec, Ontario, and then the federal government. It's a great question, Vassy, because if you get another fiscal budget stimulus on the fiscal side of things, then you would complicate the life of the Bank of Canada. So their rate outlook, I think the primary reason why Mr. McClellan did not open the door to potential rate cuts today was because he's unsure about what fiscal policy is going to be like in 2024. And that would be my biggest risk to inflation. Having stimulative budget at this point in the cycle is a recipe for the Bank of Canada to stay put on rates.
Okay, I'll leave it there. Very helpful information tonight. Thank you both for your insights and your analysis. Stéphane Marion, the Chief Economist with the National Bank of Canada, and Jean-François Perreault, the Chief Economist with Scotiabank. Thank you.